Hello everyone, and welcome to Virginia International University's MBA 605 Auditing. Today we're going to be talking about the audit of the cash and financial instruments portion. We'll talk about the major types of cash and financial instrument accounts maintained by entities, business entities, and we'll show the relationships of cash in the bank to the various transaction cycles we've also been talking about. We'll also discuss how to design and perform audit tests of general cash accounts. We'll also want to talk about when to recognize the time at which we should extend audit tests of general cash accounts to test for material fraud. And we'll design and perform audit tests of the financial instrument accounts. The general cash account is the focal point of cash for most organizations because virtually all cash receipts and disbursements flow through this account. A fixed balance is maintained in the Empress payroll bank account. Immediately before each pay period, one check is drawn on the general cash account to fund the net payroll paid from the payroll account. For a company operating in multiple locations, it is also desirable to have separate bank account at each location to facilitate local transactions. Sometimes this is unavoidable. Branch bank accounts build local relations and permit the centralization of operations as excess cash is periodically transferred electronically to the main office general bank account. An Empress petty cash fund is not a bank account, but is sufficiently similar to cash in the bank to merit inclusion. A petty cash account is as simple as a preset amount of cash set aside in a cash box for incidental expenses. And so what we've been talking about here are just the different types of cash accounts, and these can become very complicated and sophisticated depending on the size of the organization. For a global organization, we're also having to deal with the complications associated with currency fluctuations. Again, this relationship, this diagram is simply to show us or help us to understand the relationship of the general cash account which usually funds all of the other different types of cash accounts in the organization. And we can see that, well, we may have branch bank accounts where deposits may be deposited locally and that money is transferred into the general account. We may also have Empress payroll accounts to finance or to fund payroll operations, which is funded by the general cash. We may have a petty cash fund, which is used for very small minor purchases where we just want to pay cash for them, which is funded by the general cash account. We may also have an accounts payable account where we write checks to pay for the purchases as a result of our acquisition practices in the business cycle. This might also be funded separately by the general cash account. It is apparent why the general cash account is considered significant in almost all audits, even when the ending balance is immaterial. The amount of cash flowing into and out of the cash account is often larger than for any other account in the financial statement. And here again we see these relationships of cash and the bank and different other transaction cycles. So we see the cash account in the center there and how it's related to the capital acquisition and repayment cycle, or the sales and collection cycle, the payroll and personnel cycle, and the acquisition and payment cycle. Most companies are unlikely to have significant business risk affecting cash balances. However, business risk may arise from inappropriate cash management policies or handling of funds held in trust for others. Since cash is more susceptible to theft than other assets, there is a high inherent risk for the existence, completeness, and accuracy objectives or management assertions surrounding cash balances. Control over year-end cash balances in the general ledger can be divided into two categories: controls over the transaction cycle affecting the recording of cash receipts and disbursements, and independent bank reconciliations. And so we want to design and perform tests of controls and substantive tests of transactions for several cycles when we're designing the test of balances for cash in the bank. And so as with our other business cycles, we see that we're also able to design and perform analytical procedures for cash in the bank. Using these analytical procedures to test the reasonableness of cash is therefore less important than it is for most other audit areas. The starting point for the verification of the balance in the general account is to obtain a bank reconciliation for the client for inclusion in the audit documentation. And this is a sample of the bank reconciliation. And essentially what a company is doing is they're reconciling their bank cash balance as reported to the company on the month-end bank statement with their book month-end cash balance, and any difference we're able to reconcile out to understand what it is. So it could be items like a check cleared the bank for an amount differently than what it was recorded in the general ledger or cash account app, or a check hasn't cleared the bank that was recorded, so that's a timing difference. Or another example of a timing difference is that a deposit made it into the bank from a customer, but because of cutoffs, we weren't able to record that deposit into the general ledger. So there are all these timing differences, and it's not unusual that it happens. It's standard timing differences between bank and book balances, but they must be identified and reconciled to. So misstatements can happen that are not discovered as part of our bank-to-book reconciliation, and those would be items like failure to bill a customer or an embezzlement of cash receipts from customers. So these items might not fall out as a part of, or they're examples of items that might not fall out as a part of our bank-to-book cash reconciliation. Other types of misstatements could be duplicate payments or improper payments of personal services, payment for raw materials not received, payments for employees for hours not worked, or payments of excessive interest to a related party. These are just some of the examples. Now, these types of items generally, again, are not going to fall out as a part of the bank-to-book reconciliation because they're recorded. They're just recorded for a false or fraudulent underlying transaction. What we would see as a part of our bank reconciliation would be items like the failure to include a check on an outstanding checklist, or cash received by the client recorded in the wrong period. Other examples of this might include deposits that are recorded near year-end or month-end, deposited in the same bank in the same month, and included in the bank reconciliation as a deposit in transit. Another one might be a payment on notes payable debited directly to the bank balance, but not entered into the client's records. And so again, these are the types of items that we would see and would expect that would fall out of our bank-to-book reconciliation. And so you may recall these items like existence, completeness, accuracy, cutoff, and detail tie-in. These are all audit objectives which are aimed at verifying management assertions. So for detail tie-in, a test that we might perform would be to tie in the cash in the bank that it puts correctly and agrees with the general ledger. For existence, we might test that cash in the bank agrees with what is stated on the reconciliation. For completeness, we may record or test that existing cash in the bank is recorded. And then finally, for accuracy and cutoff, we can perform tests such as that cash in the bank as stated on the reconciliation is accurate, and that for cutoff, cash receipts and cash disbursements are cut off and recorded in the same period, or in the correct period. So once we receive a bank confirmation, bank confirmations are not required for non-public entities or under international accounting standards, but they are required under GAAP for publicly traded companies. However, auditors usually obtain a direct receipt of a confirmation from every bank in which the client does business. A cutoff bank statement is a partial period bank statement and the related copies of canceled checks and duplicate deposit slips and other documents included in bank statements mailed by the bank directly to the CPA firm's office. The purpose of the cutoff is to verify reconciling items on the client's year-end bank reconciliations with evidence not accessible to the client. And then finally, we have tests of the bank reconciliation, which include a verification that the client's bank reconciliation is mathematically accurate and trace checks written and recorded before year-end and included with the cutoff bank statement to the list of outstanding checks on the bank reconciliation and to cash disbursements journal. Deposits in transit can also be verified by reference to the cutoff bank statement. And what this does is, again, it just kind of illustrates for us the types of audit tests used for general cash. You may recall you've seen these examples of the types of audit tests used for whether it's acquisition, or whether it's or payroll and personnel, or any of the other types of business cycles or business functions that we're auditing as they are related to the different general ledger accounts used, that is, asset accounts or income statement accounts. And so a major consideration in the audit of the general cash balance is the possibility of fraud. And so that's why we must extend procedures in the audit of year-end cash to determine the possibility of a material fraud. The extended procedures verify whether all transactions included in the journal for the last month of the year were correctly included in or excluded from the bank reconciliation, and verify whether all items in the bank reconciliation were correctly included. And so here what we're looking for is this proof of cash, where we're looking at all recorded cash receipts were deposited, that all deposits in the bank were recorded in the accounting records, that all recorded cash disbursements were paid by the bank, and that all amounts that were paid by the bank were recorded. And so we're making sure to confirm that everything independently recorded on the bank statement was also reflected in the general ledger or in the cash account, whether that's an inflow or an outflow. And this is just an example of a proof of cash schedule where we're performing this testing. And you can see, so we start with the bank balance. We adjust for deposits in transit. These are timing issues regarding deposits. We adjust for outstanding checks, which again may just be timing issues between when a check was issued and recorded versus when it cleared the bank. We adjust for items like NSF or not sufficient funds checks, so these are return checks. Then we see notes like to allow for effective cash disbursement recorded as a credit item in cash receipts journal. There are all different types of transactions that affect the account, and so first we have to identify the transactions, then we have to adjust our bank balance for them. If we start with bank, some companies go bank to book reconciliation, others go book to bank, and then we have to adjust for those to make sure that we reconcile regardless of whether it's bank to book or book to bank. And then we also want to make sure that when we adjust for these transactions that the appropriate offsetting or debit or credit side to the entry are also reflected in the financial statements. And so these reconciliation efforts with respect to proof of cash include that the balance on the bank statement with the general ledger balance at the beginning of the proof of cash period tie out, and that cash receipts deposited per the bank statement agree with the cash receipts journal for a given period. We also want to reconcile electronic payments and canceled checks clearing the bank with those recorded in the cash disbursements journal for a given period are correct, and that the balance on the bank statement with the general ledger balance at the end of the proof of cash period also makes sense and can be reconciled to one another. So embezzlers occasionally cover a theft of cash by a practice known as kiting, or transferring money from one bank to another and incorrectly recording the transactions. So near the balance sheet date, a check is drawn on one bank account and immediately deposited into a second account for credit before the end of the accounting period. And so that's why it's important that we get this schedule of interbank transfers if a company has more than one bank account, or if it has bank accounts at multiple different banks, and make sure that we're able to account back and forth for all of the cash transactions between these different cash accounts within one bank or cash accounts between separate banks. And so with respect to interbank transfers, the accuracy of the information on the interbank transfer schedule should be verified, and we can do that by comparing these to the proof of cash or to the bank statements from each bank. The interbank transfers must be recorded in both the receiving and disbursement banks, so that we can account for both the in and out in both accounts. And then the date of the recording of the disbursements and receipts for each transfer must be made in the same fiscal year. And there again, we want to make sure that we're not violating cutoff principles, and that we're ensuring that no fraud has taken place. And so finally, we talked that the disbursements on the intercompany transfer schedule should be correctly included or excluded from year-end bank reconciliation as outstanding checks. Again, it's back to this proof of cash. And that receipts on the interbank transfer schedule should be correctly included in or excluded from year-end bank reconciliations as deposits in transit. And so again, we're making sure that these timing differences are all correctly recorded. And so lastly, we want to talk about financial instruments. And when we're auditing financial instruments, what we need to do are to identify client business risks. So what are the risks associated with the financial instruments that the client has on its balance sheet? We want to set our performance materiality and assess our inherent risk as they relate to these individual financial instruments. We want to perform the same control risk assessment that we would under any other business cycle, whether it's cash or payroll or acquisition. Based on the results of that control risk assessment, we want to test those controls, and then we also then design and perform the same analytical type tests that we covered in previous sections. And then based on the results of all of that, we want to design the test of details of financial instruments and balances. And again, the goal of all of this testing is to, at the end of it, be able to determine whether or not the account balances with respect to financial instruments fairly present, in accordance with generally accepted accounting principles, the results of operations of the organizations for the period ended. And so this then covers our section dealing with audits of cash and financial instruments. As usual, please go back and read your chapter. Don't let this substitute as a reading for that chapter. And then please move on to the practical exercises. And thank you for your time.